Hello world, my name is Jay and I am so excited that you've joined me on week one of this special segment of The Skeptical Investor where we are going to dive into dividend investing. Now, we've titled this segment Dividend Battles, and the reason why we've done that is because we want to do a bit of a case study and figure out which dividend investing strategy actually works better and performs better over time. The reason why we're doing this is because there's a lot of, I wouldn't say noise out there on YouTube, right? But there's a lot of information out there. And typically, most investors have a bit of a bias when it comes to the type of investments that they make. And usually when you check out a different, channel or a website, blog, podcast, most people tend to have a bit of a bias as to which type of investments they tend to gravitate towards. And that makes it a little bit hard to figure out which strategy is actually better, right? And so this particular segment of the channel is literally my journey as I wouldn't say necessarily an amateur investor, but because I've done a bit of research over the last year or so. But in no way am I, a seasoned investor whatsoever. But this is my journey in trying to figure out which dividend investment strategy works best or performs better. Now, what we're going to be doing is every single week we're going to document how my brand new portfolio is performing, and we're going to take a look at it. We're going to make some changes to it, make some adjustments to it, and we're going to try to pin different strategies or sectors of the stock market against each other, and they're going to battle it out, and we'll try to figure out what investment makes more sense. Now, there's 5 different strategies that I've chosen for this particular test. Each of these strategies obviously is different from one another, and although it's not every single strategy out there from dividend investors, I think it's going to give us a pretty good idea as to what type of investment is going to work best for your own particular scenario, your stage in life, and the type of results that you want to see. So there's 5 different strategies, like I mentioned, or sectors of dividend investing that we're going to be going over. And I'd like to just dive right in to my M1 Finance portfolio and show you the different sectors that I've chosen to invest into. And hopefully this might inspire you in some way to perhaps start investing yourself. Now, the name of the channel is The Skeptical Investor. And my approach to investing is going to be from a skeptical standpoint. The reason why I'm approaching investing this way is because I have no intention of losing my money. So I want to find investment strategies that work so that I can actually put my hard-earned money to work for me and hopefully multiply. So let's dive right in. And let's take a look at that M1 Finance portfolio that I just created about 48 hours ago. All right, so as you can see, here is the main page of the portfolio. And I want to show you the 5 different sectors or strategies first. And this video, we're not going to be going over all of those strategies in a whole lot of depth. We're going to leave that up for the next few weeks, but I wanted to just give you a brief overview of these strategies and also tell you very quickly why I have chosen them. So the very first strategy is investing into high growth stocks. Now, high growth stocks, and people have different ideas as to what is considered a high growth stock, right? Like people have different biases and opinions on what would be a high growth stock. But to me, a high growth stock is a stock that has the potential to appreciate in terms of its equity, but it's also a stock that gives out and pays to its shareholders a bit of a dividend. Now, these are stocks that, like I mentioned, have a good potential of appreciating quite a bit in terms of equity. Now, this investment strategy is a bit of a contrarian strategy from what most dividend investors are used to doing. Most dividend investors will invest into equities that pay them a dividend so that they can have a bit of a cash flow and have money coming in through the dividend yield. So most dividend investors will invest into stocks that have a bit of a higher dividend yield and may not appreciate too much in terms of its equity value over time. But with this high growth strategy, we're not so much concerned about that high yield in terms of the dividend itself. We're hoping that the stocks themselves will appreciate in terms of its equity value over time, and that should yield us, more equity and a larger portfolio. So this is strategy number one. The second one is high yield stocks. Now, these equities in particular, and these companies do have a bit of a higher yield in terms of its dividend. Now, with these, you shouldn't expect a huge rise in terms of the equity value of the company, but rather you expect a higher yield of your dividend. And you invest into these companies not so much for the growth potential, but much more so in terms of the amount of yield and that high percentage that it provides to its shareholders. The third strategy here is a high dividend ETF. Now, this one in particular is the SPDR S&P 500 High Dividend ETF. Now, the reason why I chose this one is because it has a pretty high yield in terms of its dividends. I believe it's about 4.6% annually. Now, an ETF is a fund, and what they do is they gather a lot of different companies and they bundle them all together into this particular fund. So when you buy into this, you're buying into a broader spectrum of companies instead of just buying into single stocks like the two other previous strategies. Now, ETFs tend to be a bit of a safer investment, and that's why I decided to get into SPYD. ETFs have become very, very popular, especially after the previous recession that we went through, because they're just a little bit safer. You have a much more diversified portfolio because you're investing into a large amount of companies that they've bundled together. The fourth strategy is REITs. Now, REITs are real estate investment trusts, and they're basically companies that invest into real estate. They're in different sectors and different markets of real estate, and you can see here that we have some companies that are in the retail environment, some other ones that deal with mortgage trusts, other ones that invest into real estate, senior housing. There's also an ETF there. Now, the reason why REITs are very, very popular to some people is because they have a pretty high yield. I'm talking like some of them have a 10, 11% yield, which is pretty high in terms of a dividend. And we're going to see how these perform over time. And the last one here is the ProShares S&P 500 Dividend Aristocrats ETF. Now, the Aristocrats ETF is actually an ETF that is made up of companies that have performed extremely well in terms of their dividend year over year. The Aristocrats, I believe they've given out a dividend and also increased their dividend for the last, I think it was like 3 or 4 decades, which is pretty remarkable for companies to be able to keep up with giving their shareholders their dividends. So this is a very, very safe ETF. And again, it bundles companies that have performed really, really well. So in order for you to stay in the Aristocrats ETF, you have to have that Aristocrats title, and you have to earn that title by consistently improving your dividend and paying out your dividend towards your shareholders. So these are companies that have been around for decades that usually perform really, really well. And this one, I'm really excited to see how it performs, especially because there's a lot of talks about a looming recession with all kinds of different factors that are taking place lately. And I'm excited to see how this performs because this particular ETF should not be affected too much by downturns in the stock market and a possible recession. So it's going to be really interesting to see how it actually performs. Now, this portfolio, I opened about 48 hours ago with $1,000. And what I'll be doing is every single month, I will be adding $200 into each of these different strategies. And again, we're going to just document how they're doing. Every single week, I'll be recording a video and show you the type of performance that we're experiencing and how each of these strategies is performing. And yeah, we're going to be investing $1,000 every single month, putting $200 into each of these strategies. I did fund this account about 48 hours ago, and you can see that we actually have seen an increase in the portfolio value of about 1%. And so that's about $10 of an increase. So that's pretty cool because over the last 48 hours, I haven't done anything and I already have $10 that I didn't have to work for. And again, that's the whole purpose of these investments into the stock market. As of right now, I don't have any dividends yet. All of these stocks have different X dates in which they pay out their dividends. So the growth that I'm seeing so far is just the equity value of the stock going up. But again, I'm really hoping that over the next few weeks, we're going to be able to see how each of these perform and how they're doing. Right now, the high growth stocks have gone up the most with an increase there of $2.47, which is a bit expected because, again, these are stocks that will more than likely appreciate the most out of all of these strategies. And then the one that follows is the high yield stocks with $2.25, which is a 1.12% increase. Right below that is the SPYD ETF with a 1.09% increase. Then REITs at 0.93%. And then the Aristocrats ETF at 0.7%. Again, all of these are kind of like expected growth percentages based off of the particular strategy and what each of these investments tries to accomplish. But again, over time, I'm hoping that hopefully I'll be surprised and, we'll find out some cool things when it comes to all these strategies and which one performs better and which one may work better for your particular scenario and where you're at in terms of the stage of your life. Thank you for joining me. I'm really excited to see the progress of these investment strategies, and I'm really hoping that this will inspire you to hopefully not just be a spectator, but also, be a participant, active participant in investing from a skeptical standpoint, because we don't want to risk our money. We don't want to lose our money. We want our money to work for us. And again, hopefully this will help you to try to figure out what might work best for you. And I just wanted to give a quick heads up. I am in no way a financial advisor. This is not financial advice. You're merely watching a story of a dude that wants to invest his money, and this is just for entertainment purposes. In no way, shape, or form would I ever suggest that you copy my investment strategies. Again, this is just a case study to try to figure out from a non-biased standpoint which strategy performs better over time. So again, thank you for joining me. I'm super stoked that you've allowed me to spend this time with you, and we'll see you next week. Take care and stay blessed.